you make over $145,000 and you're 50 or older, Uncle Sam just changed how you can save for retirement. Starting next year, high earners making more than $145,000 per year are going to lose a major tax break, and it may force you to start putting money into a Roth 401k. Miss this and you could lose the ability to make catch-up contributions entirely. First, my name is Megan Ramshaw. I'm a certified financial planner and lead advisor of MOKAN Wealth Management. Today, I'm going to be breaking down exactly what's changing, who it impacts, and the 5 things you must verify right now before this rule takes effect. Often after years of supporting burgeoning life expenses and kids and all the other things that take up money, people begin to realize in their late 40s and early 50s that they need to get serious about saving for retirement. And thankfully, the government provided a tax-efficient way to save for retirement and also to defer taxes. It's called the catch-up contribution. In 2025, you can contribute $23,500 to your 401k, and if you're age 50 or older, you can get an additional $7,500 a year in catch-up contributions. Even better, if you're between the ages of 60 and 63, there's a special super catch-up allowing your total catch-up contribution to be $11,250. But thanks to new IRS rules tied to the Secure Act 2.0, higher earners, those earning over $145,000 a year, will face some new restrictions. If you made more than $145,000 in wages last year at your employer, your catch-up contribution must go into a Roth 401k. That means no more upfront tax deductions. You'll be forced to pay taxes today, but you will be able to take the money out later tax-free. Essentially, the government is forcing you to make a Roth 401k contribution. Here's where it gets even messier. Not all 401k plans offer a Roth option. Fidelity says 94.4% of its plans now offer a Roth 401k. And Vanguard says that 86% of their plans have Roth 401ks. But that means that some workers still don't have access to a Roth 401k. And if your employer doesn't offer a Roth 401k and you're a high earner, as of now, you won't be able to make a catch-up contribution at all. And so that could be a loss for people trying to max savings late in their career. So here's what you need to do right now. Check and see if your 401k plan has a Roth 401k. And if not, push your HR team to add one right away, or you could be locked out of the catch-ups. The IRS granted transition relief through December 31st, 2025, but beginning January 1st, 2026, plans must permit Roth catch-up contributions for eligible high-earning participants or disallow catch-up contributions entirely. One other item I should mention, and it's important to note, is that the income threshold, so that $145,000, is based on your prior year's wages from your employer. It's indexed for inflation, so by 2026, it'll be closer to $150,000 a year. But again, it is based on your prior year's earnings. This wage calculation references wages subject to FICA tax, that's Social Security and Medicare taxes, meaning only pay reported on your Form W-2 by that employer counts. Your compensation is aggregated from all common law employers within a controlled group, if applicable. Now, there are a few weird quirks. For example, if you have 2 jobs, the rule applies separately to each employer. So the threshold separately applies to each person you work for. Also, new employees get a free pass in the first year since the wage limit looks back to the previous year at the same employer, which is kind of an interesting quirk. And then finally, the other kind of interesting quirk is that the Roth catch-up mandate doesn't apply to high-earning self-employed individuals who don't receive traditional wages. They can continue making pre-tax catch-up contributions. So run your numbers to see whether this applies to you or not. If you're close to that $145,000 threshold, understand that income from bonuses, RSUs, and other compensation all count toward that limit. Here's something most people aren't thinking about. If you're going to be subject to this new rule in 2026, you have one last chance in 2025 to make pre-tax catch-up contributions. The question is, should you front-load those contributions before the window closes forever? Front-loading means making larger contributions earlier in the year rather than spreading them evenly throughout. In 2025, you can still make pre-tax catch-up contributions. So, accelerating these before the mandate kicks in may maximize tax deferral while it's still available. The IRS permits you to allocate contributions at any rate during the year, as long as you do not exceed annual limits. You may max out contributions early in the year if your plan permits, including both your regular and catch-up contributions. Here are the benefits of front-loading. First, it maximizes pre-tax savings one last time before Roth catch-up is required, reducing your current taxable income. Second, more money is invested earlier in the year, which could enhance compounding if markets rise. But there's a major risk you need to know about: employer matching. Most plans match based on each paycheck, not the annual total. If you reach the annual limit before year end and contributions stop, your employer may not provide a match on pay periods with no contributions, potentially missing out on some employer match funds. Some employers offer true-up matches at year end, but practices vary. Check your plan's rules or ask your HR department. Now let's talk about whether paying taxes today on Roth contributions actually makes sense for you. The truth is, paying tax today might sting, but it could help you avoid paying taxes later in retirement. For the 2025 tax year, there are 7 federal income tax brackets: 10%, 12, 22, 24, 32, 35, and 37%. Let me give you an example of how this could impact you. Let's say you're 60 years old and you're in the 35% tax bracket, and you are taking advantage of the full $11,250 super catch-up contributions. It could cost you almost $4,000 in tax deductions, and it can have a ripple effect. It can increase your adjusted gross income. It could phase you out of other tax brackets, and it could even push you into a higher tax bracket. But here's the key question: will you be in a higher or lower tax bracket in retirement? If you expect your tax bracket in retirement to be higher than currently, Roth contributions make a lot of sense. If you expect a lower tax bracket in retirement, pre-tax contributions are preferable. Here are the factors that affect your retirement tax rate. First, required minimum distributions, or RMDs. Federal law requires distributions from traditional IRAs and employer-sponsored retirement plans starting at age 73. RMDs can increase taxable income and may push you into higher tax brackets. Second, Social Security taxation. Up to 85% of Social Security benefits may be taxable based on your combined income, which is your AGI plus non-taxable interest plus half of your Social Security benefits. Third, IRMA thresholds. That's income-related monthly adjustment amounts. Higher income triggers additional premiums on Medicare Part B and Part D. Withdrawals from pre-tax accounts increase your modified adjusted gross income, possibly pushing you into higher IRMA brackets. The bottom line is this: Roth contributions work best when you expect to be in a similar or higher tax rate in retirement. The fact that we're at historically low tax rates currently is an argument in favor of the Roth. Do you already have too much in pre-tax accounts? I see this all the time. People come to me and they have this massive amount of money in their tax-deferred account, and they're still piling more money into it. And we're never going to be able to get that money out in a tax-efficient manner. Large accumulations in pre-tax accounts, traditional IRAs or 401ks, can result in high taxable RMDs beginning at age 73, potentially pushing you into high tax brackets. This is what we call the tax bomb. Here's what happens: high annual taxes due to large RMDs, increased IRMA Medicare premiums from higher modified adjusted gross income, a larger portion of Social Security benefits becoming taxable. Many high earners who are later in their career and at the point of catch-up contributions have already put too much money into a pre-tax account, creating a tax bomb once their required minimum distributions hit at some point in the future. So while this change feels like a tax hike to some people, for many people, I think it could be a blessing in disguise. Some high earners should be forced into a Roth 401k or putting their money into a taxable brokerage account because they already have enough money in a tax-deferred account, and they're going to have a tax problem down the road. Many planners recommend Roth conversions during the lower tax years, for example, early retirement before RMDs or Social Security begins, to smooth out taxable income and mitigate tax bomb risk. Being forced to make that Roth 401k contribution might not be the worst thing for you. Consider tax diversification and your brokerage account. Don't just think about putting everything in a pre-tax account or everything in a Roth. Also consider your taxable brokerage account. I've never had anybody say to me, "I wish I had saved less money in my brokerage account." So don't discount using your brokerage account. It's not just about a traditional IRA and a Roth IRA, or a traditional 401k and a Roth 401k. But you should also consider, should I just be putting more money into my brokerage account as I prepare for retirement? The truth is, most workers like the upfront tax break of the traditional 401k contributions. According to a study by Vanguard, they said that of the people who have access to a Roth 401k, which is now most people, only 18% of people take advantage of it. And I think it is one of the more underutilized tools because the Roth has some incredible benefits. You pay tax today, but the withdrawals in your retirement are going to be tax-free. And if you use this to be your more aggressive bucket, it can be a really powerful tool because you're able to build a tax-free bucket of money for later in your retirement. Having both Roth and pre-tax balances gives you flexibility, what we call tax diversification. Don't just think about the Roth 401k in relationship to your catch-up contributions. For some high earners, it might make sense to contribute more money to your Roth 401k in addition to just the catch-up. So begin thinking, how much do I want to put in Roth 401k, or do I want to put money into a brokerage account? This is the first time the tax code has ever mandated Roth 401k contributions, and I think it's kind of a big deal. In fact, I think overall it could be positive. It can be a headache in the short term. It's going to feel bad for some people to have to pay a bit more tax because we love saving taxes today. But I think this could mean that more people are going to become aware of Roth 401ks and more people are going to begin taking advantage of it. And I think in the long run, it's going to set many people up for a much more tax-efficient retirement. If you want help navigating these changes and creating a tax-efficient retirement strategy, we help self-made 401k and IRA millionaires keep more and pay less in taxes through our 5-seed system. Get started now by clicking the link in the description to see if we're a fit. You can also check out more resources on my YouTube channel.